Right now, the UK banking system isn't collapsing. There are no panic headlines, no queues outside banks. And that's exactly what makes this moment so dangerous. Because banking crises don't begin with chaos, they begin with silence. While attention is elsewhere, pressure is quietly building beneath the surface. Higher rates, falling property values, rising debt stress. And by the time everyone starts talking about it, it's already too late. The question isn't whether something is wrong. It's why almost no one is paying attention. Welcome to UK Economic Report, your go-to channel for the latest updates on the UK economy. From inflation and interest rates to housing trends and government policies, we break down the numbers so you can understand how they impact your finances. For years, UK banks have insisted they are stronger than ever, better capitalized, better regulated, safer than during the 2008 financial crash. On paper, the system looks stable. Stress tests are passed. Balance sheets appear solid. Executives reassure investors. Regulators project confidence. But history has taught us something uncomfortable. Banking crises rarely begin where everyone is looking. They begin where no one wants to look. The warning signs are subtle, but they are everywhere. Rising interest rates were supposed to restore normality after years of cheap money. Instead, they have exposed fragilities that were quietly building for more than a decade. Households are struggling under heavier mortgage payments. Small businesses are being squeezed by higher borrowing costs. Commercial property values are falling. And banks, sitting at the center of all this, are absorbing shocks from every direction at once. Take mortgages. Millions of UK homeowners are rolling off fixed-rate deals that were locked in during an era of near-zero interest rates. Now they're refinancing into a world where rates are dramatically higher. Monthly payments are jumping by hundreds of pounds. Delinquencies are creeping up, not exploding, creeping. That's the key word. Crises don't always start with mass defaults. They start with gradual pressure, with margins thinning, with stress spreading unevenly across the system. Banks insist they've prepared for this, but preparation assumes predictable outcomes. What they're facing instead is a slow grind that eats away at profitability and confidence simultaneously. Higher rates boost interest income, yes, but they also increase loan losses. And when economic growth slows at the same time, that trade-off becomes far less attractive. Then there's commercial real estate, one of the most under-discussed risks in the UK banking system right now. Offices are sitting half-empty. Retail spaces are struggling. Property values are adjusting downward, sometimes sharply. Loans that once looked safe are suddenly backed by assets worth far less than expected. Again, this isn't a sudden collapse. It's a revaluation, slow, uneven, and deeply dangerous for banks heavily exposed to property lending. Regional banks and smaller lenders feel this first. They don't have the global diversification of the big institutions. When a few large borrowers get into trouble, the impact is immediate. Liquidity tightens, risk appetite shrinks, credit conditions harden, and the ripple effects spread outward into the real economy. What makes this moment particularly risky is timing. The UK economy is already under strain from high living costs, weak productivity growth, and fragile consumer confidence. Banking stress doesn't happen in isolation. It amplifies everything else. When banks pull back on lending, businesses delay investment. Hiring slows, wage growth weakens, consumer spending drops. And that feeds back into the banking system again, in a loop that becomes increasingly hard to break. Yet public discussion remains strangely muted. Why? Because this isn't a dramatic crisis yet. There's no single villain, no collapsing giant bank, no obvious panic. And politically, acknowledging banking stress is inconvenient. It raises uncomfortable questions about regulation, monetary policy, and the long-term consequences of years of financial engineering. The Bank of England is walking the tightrope. Raise rates too much, and you squeeze borrowers and banks further. Cut rates too soon, and you risk reigniting inflation while undermining confidence in monetary discipline. Every move carries trade-offs, and none offer a clean exit. Central banks are no longer firefighters. They re-crisis managers trying to prevent sparks from becoming flames. Another overlooked pressure point is government debt. UK banks are major holders of government bonds. When interest rates rise, the value of those bonds falls. That doesn't necessarily cause immediate losses if the bonds are held to maturity, but it weakens balance sheets and limits flexibility. We saw how quickly this can become dangerous during the gilt market turmoil. When pension funds nearly collapsed and emergency intervention was required. That episode faded from headlines, but the underlying vulnerability didn't disappear. Confidence is everything in banking, and confidence doesn't vanish overnight. It erodes. Quietly, a few cautious depositors move money. A few investors demand higher returns. Funding costs rise. Margins compress. Suddenly, what looked manageable starts to feel fragile. What's particularly worrying is how familiar this all feels. Not in detail, but in rhythm. Before every major banking crisis, there's a period where experts argue that this time is different, that safeguards are stronger, that risks are contained, that the system can absorb shocks. And usually those statements are partially true until they aren't. The UK banking system today is not the same as it was in 2008, but it is not immune to structural stress either. High leverage still exists, just in different forms. Risk hasn't disappeared, it's been redistributed. Hidden in shadow banking, private credit, complex financial instruments, and interlinked balance sheets that only reveal their weaknesses under pressure. And here's the most uncomfortable truth. The longer this goes unspoken, the worse the eventual reckoning becomes. Markets don't fear bad news, they fear surprise. When problems are acknowledged early, they can be managed. When they are downplayed, they grow. This isn't about predicting an imminent collapse. It's about recognizing that the foundations are under strain. That banking systems don't fail loudly at first. They fail quietly through complacency, denial, and delayed response. For ordinary people, the consequences are real. Tighter credit, higher borrowing costs, fewer opportunities, slower growth. And when banks finally do demand attention, the solutions tend to involve public support, regulatory backstops, and policy decisions that affect everyone, not just those who took the risks. So why isn't this being talked about more? Because it's complex. Because it doesn't fit neatly into headlines. Because it unfolds over months and years, not days. And because acknowledging it would force a broader conversation about how fragile modern financial systems still are, despite everything we claim to have learned. Thanks for watching UK Economic Report. Don't forget to subscribe and hit the bell icon to stay updated on the latest UK economic news, expert analysis, and financial insights that matter to you.